Good morning, everybody. Welcome to the Flow Show, the day after Powell and the Fed. Not a lot went on there, but we'll get through those headlines nonetheless. US holiday today, so we could be facing maybe a quiet day later on, headlines permitting, of course. We don't know what's going to be coming out of those, but could be a little funky day today. Morning, Kay. How you doing?
Morning, Ryan. Morning, everybody. Yeah, I'm doing fine, mate. Doing fine. As you say, yeah, most of the US markets will be closed, so it could be that this afternoon is a quiet one, yeah. But
Yeah.
as we know, the orange hurricane is never far from his Truth Social platform.
Yeah, exactly. Always got his mobile phone to hand. Right, let's get stuck into it. Well, before I get stuck into it, just want to make you aware once again, and I'll put the link in the chat there, are coming soon. I can call it an offer, but feature, shall we say, are evolving into trading analytics. Exciting things coming up. You don't want to miss out. So sign up for our newsletter there to find out more. If you sign up during the month of June, you will enter a draw for a $25,000 trader funding account assessment. So get in there, we'll pick a lucky winner. We're going to have more little bonuses along the way and more details as we get through the development stages of this new venture, new project, new product. So get in there quick. This list will not be open for long. We are going to close it before the actual launch. So if you're not in, you'll miss out on all the pre-launch goodies. Right, anyway, moving on, we're going to start in Japan, where the Ministry of Finance has told us what it's going to be doing with its bond sales for fiscal year 2025-2026. They're going to come down by 500 billion overall. They're going to cut sales of 20 and 30 year, that's super long bonds, by around 900 billion. They're going to raise or increase sales in 2 years, 1 year, and 6 months by 600 billion. They're also going to increase sales to households by around 500 billion as well. So what they're doing is they're taking supply out from the super long end, those 20s, 30s. So less supply means that prices should go up, which means yields should come down. So less bonds, more demand, that sort of thing. That's the hope anyway. We shall see what happens with that. No real move in the end on that. Largely expected. Kay, any surprises in the numbers?
No, I wouldn't say so. Yeah, as you say, all as expected. They've already been announcing that a good few times, so yeah, it should not have moved, and it didn't.
Yeah, absolutely. At least we know what's coming now. Right, bit of data out as well. We had New Zealand GDP kicking off for Q1, coming in at 0.8%, slightly better than expected and up over Q4. Year-on-year number, not as bad as expected. Came in at minus 0.7 versus minus 0.8 previously. The annual average in Q1 running at minus 1.1%. So not overly bad data there. Okie dokie data there. Then we had Australian jobs, which bit of a strange one. Okay, so we're expecting another 21k gain. It came in at minus 2,500, but there were some thoughts that it might give back a bit more after that big April number. So it wasn't bad as expected, or rather it could have been a lot worse. The unemployment rate stayed unchanged at 4.1%, though the participation rate came down a bit as well. So people coming out of the market might have had a bit of influence in keeping that unemployment rate where it was rather than ticking up. So overall, it was negative. There was a loss in jobs, but it could have potentially been a lot worse after that big, strong April reading. The SMB, they cut rates 25 pips as expected. A few people just keeping half an eye out in case they went a bit bigger and decided to take things into the negative. Schlegel says we would not take the decision to go negative lightly. Pretty much most of the press conference was talking about negative rates, the fact that it's there, but the fact that they do seem very reluctant to use it. But there's only one other way they can go from here. That's rates up or that's into the negative. So as much as they are reluctant, they're keeping it on the table. So it is going to be a possibility coming up. How close a possibility might that be, Kay?
It will take another series of data. And just a reminder, they only meet once a quarter, right? They don't meet monthly or 1.5 months apart like the other main central banks. So this, in theory, fixes what they are doing for the next 3 months. So I think what it will take is a further deterioration in the just simply put the trade balance. If the Swiss corporates continue to see after the front running, the front loading, where they have been quite happy exporting. We see those data coming out now with a big drop in the exports. So if that continues, then I think they will be tempted. And the other thing that they will keep open, obviously, is the intervention. But Schlegel is a lot less interventionist than Jordan may have been, right? He did say something about we will intervene if it's necessary, but that's just a line in there. Over the press conference, he was a lot less. How shall I say, combative like that compared to what Jordan has been in the past, where he said like, well, this is not good. I'm not saying that Jordan would have gone negative, but I'm think that he would have hammered a lot more on potential interventions because the Swiss franc is hurting the exporters. So for them to go negative, as Schlegel says, it's going to take something. But if we see a continuation of the data as they are now, inflation is coming down, growth is far to be sought, and the trade balance is not going the right way. Especially the exports, all right, and that's I think where we have to look for further hints whether they can go into negative or not. In the meantime, as we will see from the rates, I think the market was really hoping for them to be a lot more dovish, which they haven't got, and I think people got a little bit wrong-footed with their positions and a lot of hopium again. But again, Schlegel is not Jordan.
Yeah. Do you think they're going to be looking to do a bit of smoothing if
Yeah,
we see the Swissy gaining from this point?
yeah. The thing though that we need to remind, and maybe our audience, for those who are newer to markets or haven't had the experience of SNB intervening, is that they usually do not buy aggressively in the market. They don't go to market and aggressively buy. They will find a level where they judge it's not warranted to be there, or it's not the right level for the Swiss franc, and they will probably sit on the bid. Whether it is in dollar Swiss or euro Swiss is also going to have its importance because of their FX reserves strategy, which is about 80% is spread over dollars and euro in roughly. They I think there's a slight higher percentage of dollars right now compared to euro, but it's really a very minor difference. It might be that the one is 40%, the other 38 or so. But it's going to be important because if they first decide to intervene in euro Swiss, they will have to rebalance about half of the euros they buy into dollar Swiss because of their FX reserves composition. So that may weigh on the euro dollar. And the inverse is obviously true as well. If the dollar Swiss would fall out of bed and they decide this is enough, then it should be supportive for euro dollar on the other hand. But the main thing here is that apart from exceptional events, SMB is not going to the market and pay the market. They will sit on the bit, okay? And that should, in theory, come at levels. They will not tell us as much, but we will see the hints, I guess. And obviously, we will see it in the data as well, but those data are so most of the time delayed unless they intervene right at the end of a month.
Yeah. Well, George asked the obvious question that a lot of people asks about the Swissy. Why is it now strengthening after the cut, and even comments of negative rates? We know that often these days markets don't move the way you'd think they'd move on rate decisions. But what's the main basis behind Swiss strength at the moment? Is it risk, Kay,
Yeah.
or just a
I think it's
confidence
pure
question?
risk, and then people's hopium for a deeper cut. The thing is, Um, and I've said that yesterday, I think on Face as well in our chat room, we have to also know that in the bigger money investments, Swiss is not a big currency, right? It is coming even far behind stuff like the yen, for instance. The main investment instruments for investors, asset managers, sovereign wealth managers, and stuff like that are obviously, if we take only the currencies, are obviously the dollar, the euro, part of, and then we drop off a cliff quite rapidly. Then you have the yen, and then you have stuff like sterling, Aussie, and Kiwi, which and Canada, which all come well above percentage wise what people may have in Swiss. Swiss is really um, risk and speculation. We have to look at it like that. I mean, it's not something because people say like, well, okay, and it is in parts true, but Switzerland, let's not forget, is still a parking place for a lot of um, white and less white money in the thing, and that is not necessarily put in Swiss franc, but it gives Switzerland this kind of haven, whether it's safe or dodgy, but kind of a haven status where you're going to need a quite negative, which I think is in place somewhere, a quite negative outlook for the country to see the Swiss franc materially weaken. But of course, in the short term, we're talking about risk basically. If the shit hits the fan in or more than it is now in Iran, you will probably see Swiss franc strengthen a little bit on the back of it again, because also over the past months, I find Swiss franc being one of those being the currency which really benefited the most from safe haven flows, even more than the yen.
Yeah, yeah, absolutely. Yeah, geography has lot to play sometimes. In part, yeah, it's nothing ever moves always in the same lines, be it risk or whatever. We've seen that with risk and this US dollar risk on, risk off moves we've seen. Anyway, thanks for that, mate. Good stuff. Norges, they pulled a little bit of a rabbit out the hat, cutting 25 pips. We're expected to stay unchanged at 4.5%. So that reaffirms our call all the time that you never say never, with particularly with central banks, that they might do something no one was expecting. It's worth noting, though, that this is one of the central banks that still has rates above 4%, like the
Mhm.
Fed, like the BOE, okay, and they're still in that place where they don't want rates this high, okay. Got to keep that at the back of your mind, irrespective of what the Fed says, what the Bank of England says. They still don't want rates this high. Apparently, they're going to reduce the rate further over the course of the year, with Governor Bachet saying that they plan one or two more rate cuts this year. Kay, anything extra from the Norges?
No, but as I said, I really I thought there the analysts were a bit too complacent. None of them expected a rate cut, and I was like, okay. I think it is actually possible because they are that high. Their inflation is within somewhere sight of what could be a target. And I'm really I thought the possibility was there. And then, as you say, their rates are still above 4%. This is still in the if you take the G11 kind of picture, they are still a high yielder in there as well. And we are seeing oil ticking up of late. So I think they were in a kind of position to do it, and they did. Now, whether it's going to have a long-lasting effect on the currency is going to really depend on risk on the one hand, because we know the Scandinavian currencies trade with risk, but then I would rather look at the Stocky than the Norwegian kroner, because risk is going to be kind of opposite one from the other, because more risk for oil, meaning oil higher, should actually support Norwegian kroner and weigh on the Stocky. So it's rather the Noki Stocky that's going to move on the back of all those things. But the fact they are hinting at more rate cuts to come is potentially having a stabilizing effect. And where, as you see now, that euro where you were just on there, Ryan, I think we can stare, but it looks like this level here is kind of starting to be a stability level. It's a big zone, but then as well, we if you link Norwegian kroner to oil and gas, that those stuff move a lot as well. So maybe stabilizing a little bit rather than if they would have stand pat. I think there was a case for Norwegian kroner to actually strengthen more. But this time perhaps they just stopped it for a bit.
Yeah, and that's really looking fairly stable for this one. You know, really tight range, sort of one big figure between sort of 11s and 12s.
Yeah, but
You know,
you're talking about a 10% move there, eh?
yeah, I know, but you know, you look at
Yeah.
dollar knock. You know, it's you could call that a bit of an uptrend, a slow uptrend, and a bit more volatile there than what we've been seeing. But yeah, you know, it gives you levels, it gives you ranges. Best things to trade sometimes if they respect the edges. Right, moving on to the ECB clowns. ECB's Pancetta says the ECB to remain flexible and will decide meeting by meeting. ECB's Centino's on the worry bus. He says with growth not coming, inflation won't be at 2%. He's very worried about growth in Europe. ECB's Nagel on Villeroy's Victory tandem bike says ECB's mission is more or less accomplished. And Victory at Villeroy was out as well, saying if the ECB moves in the next 6 months, loosening is more likely. Bit of data out from the Yankee Doodles yesterday. We had housing starts and permits, which were a little bit softer than we were expecting. Permits coming in lower at 1.393 million. Housing starts coming in at 1.256 million, so lower than prior, lower than expected. Not huge moves. We've seen these sort of swings before. We still haven't got any sort of trend developing in these numbers or any big negative trends developing. So again, more hard data that might be having a little wobble, but not exactly falling off a cliff. Jobless claims is a big old meh as well, though we are sticking around that 1.9, 1.9 and a half in continued claims, initial claims ticking around the 240 area, 250 area. But again, not rushing anywhere that anyone needs to panic about. There was very much a complete lack of panic at the Fed. They kept rates unchanged in the 4.25, 4.5 range last night. They took out their line on risks of high unemployment and inflation. So they're becoming less worried about those risks, whereas they've been a feature of their past meetings. Not a lot else in the statement. Rate futures now see a 71% chance of a cut in September versus 60% before the Fed. October, those odds are now 85 versus 80% pre-FOMC. We're still largely pricing 2 cuts for the rest of the year. So we've got 4 meetings left. The Fed are dotting 2 cuts. The market's round about 2 cuts. We could probably rule out July because it's the summer and they're not going to do anything then. So that's really 3 meetings left for potentially 2 cuts. So there's going to be a bit of a squeeze on price expectations if we get closer to September. Obviously, we've got to rule in the Jackson Hole shindig, piss up, because that can be a little bit of a heads up on what they may do, sort of a in-between meeting shindig that Powell might use for some communication. Well, I think there's a Jackson Hole this year. I haven't actually checked. Powell himself decided to have another go at guessing the PCE numbers, or telling us the PCE numbers. He thinks PCE, which is coming next week, rose 2.3% from 2.1% in April, and the core up to 2.6%. He actually got one wrong last time. He was out by a pip in his call, but he might have just done that on purpose just to show that he's not really getting the numbers early. He said uncertainty peaked in April. It's since come down, but it's still elevated. So sentiment has come up from very low levels, though it's still depressed. We can perhaps see slow continued cooling in the labour market, but nothing that's troubling. It says no one holds rate path projections with a great deal of conviction. We can make a case for any of the rate paths in the projections. So basically saying the dots are a load of old shite. Likely we will get to a place where cuts are appropriate, and we will learn more about tariffs over the summer. So you might have one eye on the airport himself. They're also going to talk in more detail about changes to communications, including their summary of economic projections, i.e. their forecasts, in the autumn. This is following their framework review. So according to Powell, he wants to look at if they can improve communication, but he also said that more communication doesn't exactly, or sometimes doesn't mean improved communication. So we'll get something on that in the autumn. Kay,
You,
Powell, go on.
Yeah, move on.
Make it an interesting story.
I mean, basically, everything was set in the first minute or after a few minutes, where he said we're in a good position to be patient. And yeah, the interesting thing is that if we want to pick something out, is that they are, well, I mean, they are still very relaxed about the labor market. I think they feared perhaps a more immediate impact from tariff threats, or prices for the imports getting higher and immediately weighing on businesses after the front loading that we saw, and that's where he said now we have greater or less uncertainty was the term. So now they can wait. The other interesting thing is that down the line, if and he said as much, if we don't get all those threats from tariffs, like the biggest worries, it's actually going to probably weigh a bit down the line on inflation. So then they may have more certainty for that side to perhaps cut a bit, but then we may see the other hard data hold up, and then they will still be at the same level. Look, I think they are patient. I think there are a few cuts coming, but it's now going to be case, is that labor market going to materially weaken over the summer? And if that's the case, then regardless what inflation does in the short term, I think they will cut. But again, it's probably now, unless we get surprise, weak data is probably not going to be for the July meeting.
Yeah.
And then he will have He will have an extra set of data before the Jackson's Hole.
Yeah. So let's assume that all these trade deals are going to happen, and that uncertainty is going to roll back further. What do you think that the levels are for unemployment or the jobs market to weaken? I mean, if we see some mild weakening, some 50K prints, unemployment at 4.3, 4.4,
No, that's
nothing
not
that's
enough.
gangbusters. Do you think they will use any minor weakness in the jobs market just to get those rates down to where
Um,
they like them?
uh, no, I don't think that's enough. A few months ago, they were actually having that range, that unemployment. I don't know whether I really haven't looked in details to yesterday's report. I was just musing about the margin of errors that they may have, which made me think about the ECB's neutral rate. But I don't think that 4.3, 4.4 is enough, providing that the rest is not falling out of bed. It's going to take, because that is still going to be on the top end of their expected range in the shorter term. I think we will need to see 4.5 or above, but it's not going to take a full percentage points. That is important, I think.
Yeah,
I'm not saying that they are limit border right now of cutting, but it is not going to take a 1% worsening in the jobs market. From 4.2, if you go to 4.5, I think that's going to be enough. Um, in the space of like literally 2 months. I'm not saying if it's over a year. I mean, then they probably won't have to do anything. But you have to look at. I mean, if you look at the global markets, bonds have stabilized. All right, you still have like the 10 BPs here and there moves, but bonds have stabilized. Equity markets are still at very, very lofty levels. Okay, the unemployment level is still relatively low. Now the risk is that Trump goes into an accident. Okay, and they know that, and I think that's pretty clear. About when we listen to anybody really, but especially the Fed as well, there is a potential, the only accident coming, that Trump does something that really hurts the US. Now, in the meantime, on the other hand, you have to also look at how worried is the market going to become the further we go with tax cuts and the rise in debt. Now, we've been talking about it as well. I mean, many times already in the past. I mean, I've been hearing this debt issue for the past 40 years, right? And I mean, the US is still there, like any other country with a high debt level. They are still there, and then it's a case of getting a bit worried, having a bit of a wobble in the bond markets, and then stuff comes back to normal. But I mean, if the debt is a worry, what can the Fed do about it? I mean, yesterday he was asked, yeah. I mean, yeah, you're always talking about potential cuts, but what about the hikes? And he was very evasive about not really wanting to answer. He was like, yeah, nobody excludes anything. There are base cases, but I mean, this is the base case right now. I'm still thinking that if it would be only for debt, we would be going more quickly into QE than to raising rates. The Fed would hate to have to raise rates again, and that I think is still pretty clear. But how much is going to worry the market? I think we rather find it back into lower bonds, lower dollar, instead of like, are they going to do something with the rates? And then perhaps QE. But QE, you water down the country's finances with QE, right? So
yeah,
QE would be a negative for the dollar, regardless what happens with the interest rates. I mean,
yeah. I
that's
mean,
about how I look at the whole spectrum of possibilities. Yeah.
Yeah, but QE on that basis, if it's to support the government finances, that's a different kettle of fish altogether than just doing QE for purely for monetary policy
Yeah.
easing and so on. But yeah, I mean, I'm in line with the Fed, and I still,
Yeah.
I was in the same boat. We've had all this bad sentiment, we've had all this uncertainty. Firms don't like it. We've seen that in sentiment data. We've seen it in the PMIs, but it hasn't translated through to hard data. But manufacturing, that was in the dumps before Trump came in anyway. So
Mm.
there's still a possibility that everything in the next couple of months, Iran, Israel sorts itself out, Russia, Ukraine sorts itself out, trade deals sort themselves out. But you do see a little bit of a pickup in activity in the US that may bring some inflationary pressures with it because everyone feels confident. So they think, right, yeah, business
Yeah.
is picking up. We can charge higher prices, make more margin. And then that's going to potentially keep the Fed on their hands for a bit longer. But
Mm.
I think it'll also catch the market out a bit because the
Yeah.
market will think, get over this hump, the Fed can get back to cutting. And that may not be the case. And
Mm.
maybe that's a trade to come in the months ahead.
Yeah, you're right. I mean, for the time being, we may still be. I mean, with IP coming down, a bit of like slowing down. We have seen data where yesterday as well, Microsoft is announcing more potential layoffs as well. I mean, there is a slowdown in the jobs market, but for the time being, maybe in the data, we are just in give back territory from the front loading that we have seen ahead of Trump's taking the seat, right?
Yeah.
So I think we still have to see the real impact of any potential issues that may arise from deals, because it does look like if you hear the EU this morning that if they would strike a deal, there would still be some tariffs remaining, and I'm still not out of the not really out of the real impact of what is going to have. What's a 10% tariff if you apply it both sides of the pond?
Yeah,
Who is it
exactly.
going to hurt most?
Yeah, that's the thing. It'll all get offset one way or another. And
Mm.
yeah, that become an adjustment and then everyone will get on with life as normal. Right, let's move on. Besant says he'll likely meet with China in about 3 weeks, according to New York Post. He says China's 30% share of global manufacturing is too high. Mexico's Shine Bomb says Mexico and EU to share trade deal details in October. As Kay mentioned, the FT reporting that the EU is apparently weighing up a UK-style trade deal with the US, which, as Kay says, would keep some of the tariffs in play. Right, Iran, Israel stuff. There was a tweet out from Egyptian news source saying that Russia has threatened to intervene in the war if the US participates alongside Israel. Trump, speaking on Iran, said next week is going to be a very big week, maybe less than a week. He also spoke to Russia's Putin the day before, saying Putin offered to mediate on Iran. Now, if you want to know why Russia's got is piping up about Iran, Putin told us that they have workers at the Al Bashir nuclear power plant and have agreed with Israel that it will ensure their safety. So they have boots on the ground there, saying Russia and Iran would be able to continue work in nuclear energy. It says Russia's strategic partnership treaty with Iran does not envisage military cooperation. So this is again a bit of insight into why Trump may be reluctant to go stepping in, because it's yet another confrontation with Russia in a different area. Trump, anyway, says later on that he hasn't made any final decisions on whether to militarily intervene or aid Israel. It says if Israel does a good job, we will not need to fight. The good old Council of the Willing, all this lot, this club who all got together over the Ukraine-Russia, coalition of the Willing, who got together over this Russia-Ukraine stuff. They formed another little club as my mate Alex on Twitter said, called the League of Losers. This is ministers of Germany, France, the UK, and some top EU diplomats. They're apparently going to hold nuclear talks with their Iranian counterparts on Friday in Geneva. So that may yield something if we haven't heard anything since then. But yep, that League of Losers, obviously fronted by busybody Macron. They've got another little club going. There are lots of countries, though, that are taking staff, diplomatic staff, others, citizens out of Israel now too, including China and a few others. So there's a bit more cautiousness coming into the Israel side of things at the moment. Putin was waffling again, or continued to waffle, saying Trump is right that the Ukraine war would not have happened under his presidency. It says our negotiating teams are in contact with Ukraine, saying the next meeting is possible after the 22nd of June. So that situation is still bubbling on. That's it on the headlines. Kay, anything special else?
No.
Good. We shall move on. I don't know what we're doing today. I think must be pub
Bank
time
of England,
now.
Ryan. Bank of England.
Oh shit! Yeah, clowns. How could I forget? Oh, the bloody Bank of England. Yeah, we got the Bank of England. Oh, fucking hell. Here we go. Right. No rate change expected. Rates to remain at 4.25%. The votes will be important. Expectations are looking at a 7.2 for unchanged. That's really probably where all the action's going to be initially, just to see if it's more or less dovish than that 7.2. Something like an 8.1 for unchanged would be less dovish. Anything more, 6.3, 5.4 pushes us closer towards another cut. There's no presser, thank God, because we only get those at the monetary policy meetings once a quarter. So it'd just be the text and the statement, and then Bailey, if he decides to pop up on hospital radio later on or somewhere, just to give us his back and forth. So, Kay, got any expectations?
No, but perhaps a little more dovish than maybe the 7.2, 6.3, something like that.
Yeah.
On the back of on the back of data, wouldn't be a surprise. That I think they're probably leaving the rate unchanged unless they want to do give us an August bank. As far as sterling is concerned, it's lost its shine, and we have been talking about that, right? We were looking at the euro sterling, but sterling has lost some of its shine. I think we're going to need a bit more positive news for it to come back. So I'm not really interested in having much of a position right now, because we are at a bit of a resistance in euro sterling at 85.5, 60. But I would not be surprised that sterling as a currency, and I'm not really, don't really have a preference for what the other side of the pair is, but not really, wouldn't be surprised if the sterling just gets that extra little knock on the head on a bit of a dovish Bank of England. Now, the whole market knows that the Bank of England, in general, apart from a couple like Mann and what's the guy's name? Bill.
Dingra.
Sorry.
Dingra.
No, Pill. They usually want to wear on the more hawkish side, but yeah, let's just say I wouldn't be surprised if we get a little more dovish, Bank of England meeting. But I'm not planning to trade much of it, to be honest. Especially with the US off, you could have like a quick algo blip, then everything back to the middle, go the other side to get all the short term is stopped out, and then you come back and exactly where you started, and that is a very likely plan, plan for the Bank of England today.
Yeah, I'd be leaning that side, that there might be a bit more dovish. I don't know. It's probably too far to think they'd put a cut out, but next meeting isn't till August. give a little bit of a boost over the summer. You know, you never know with this lot. So I definitely wouldn't have it as a 0% chance that they don't cut. We shall see. It'll give us a bit of interest. I think what you got to look at for the quid is what's the mood at the moment. Well, cable's just sitting around the middle of the range. Well, maybe towards the high end of the range at the moment. Let's come into the short term. Let's have a look at the old 15-minute. So we're not looking overly bullish over the last couple of days. So something dovish is probably going to see this a bit lower. I don't know if I'd sell a rip. Like you say, it's, you know, this holiday-induced day today. The dollar is looking a bit more loved, shall we say. So maybe a rally is something to look at. Euro sterling, that might be a better pair to look at for a trade, but again, we probably shouldn't expect too much. Anything that's, you know, if we get a surprise 8-1 hold, that might see this dropping back down, maybe 85.20 is maybe the figure. I may even look at that for a little bit of a counter trade. But yeah, I'm not got great hopes for that one, but we'll have our eyes on the screen anyway for that. Right, okay, I'm going to pick it over to you, mate, because time's ticking on.
Yeah, but today I'm not having a lot actually to show. Yeah, the dollar is doing better, obviously, because again we're always talking about hopium, and yesterday the hopium was for the Fed to perhaps show a little more dovish, but it was more hopium than expectations. Euro dollar dropped. Well, first of all, had this little jump higher, which I don't really know why it was, but we are through, but a very steep trend line here. But we are below 115, so if there is more to be done, we could potentially see a move into the low 114s. But is it justified to do more? Uh, of course, geopolitics are at play, and we have seen that the hint of an involvement in Iran by the US has put safe haven support under the dollar. So don't dismiss the risk of such a headlines. Yes, the Fed was on hold, so less weight on the dollar as well. Could probably continue, but all in all, the 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 bigger move is still intact, very much intact, in my opinion. So, but there is, like I said, you have to allow for those kind of moves to come, and then perhaps go back more into the middle. Yesterday, I think it was no real surprise that the euro dollar went in to the FOMC at 115. It For the real short term, that looks to be our sort of equilibrium zone, give and take 50, 60 points around it, perhaps, or less, if you want. 40, 50 points could be the case as well. But I think we need to allow for this to perhaps a few more weak short dollars to get rinsed, and then we will pick up what we were doing before. I don't think the global picture has really changed yet, but we are for sure in a period where the dollar is less offered, of course. Yeah, that cable. It has broken this little trend line here. And the prior low as well, below 135.15. This is now your real resistance. We are a bit below, but it's a relatively short term, because I zoomed in, chart. So we really need to get back above 135.15 to start going again. A bit of support where we ended. We briefly dipped there below the 134, and we just ran into the 50%. So 133.85 is your level to watch on the Bank of England today, I guess. And if that would not be enough, then you're talking about slightly bigger levels around that 133, 132.90, and if you look left on the charts, you will see that those levels are a little bit bigger as well for the sterling. Just keep an eye if anything, because yes, the sterling has lost some of its buoyancy, but is it completely out of the game? And is the dollar really ready for a bigger jump higher? Still remains to be seen. If we ever get like an outsized move because it's a holiday somewhere down to 133s, I'm going to get quite tempted to pick them up again. Equally, if we get on a bit of a stubborn Bank of England to move higher at 135, just keep this in mind, because it was a bit of a break there, okay? And then keep also in mind the mood in the dollar right here and now, which is less dovish. I'm just look at this level. I think it's worth if we would come here for the Bank of England. Yeah, the Swissy. Um, we overshot very slightly, well, a little bit, that dollar Swiss little channel here, but we stopped in the fib zone just above 82 as well after the SMB, and we are now trading back below that, well below the 82. It's really maybe more rather than the trend line. It's rather this level here, just in the low 82s, which will be important. And we are back onto this pivot hinge zone, 81.5. If it goes back below 81.5, we may have a look back down to 81, the figure. Euro Swiss, better hold for the short termers, better hold this 93.5. Otherwise, we could have a look back into the 93s. It does give the impression that right now we had this little look down again here, but we are holding. Still, global picture, if you look at the longer term, it's actually still negative, but it's a 0% currency. And yes, risk. But if you take risk apart, I think there's enough reasons for this to sooner or later to have a look at the top side. Yeah, okay. I'm going to have a look at the metals, and then looking at the clock, I'm going to give it back over to Ryan. As you can see, I took my zone out here because it's just getting traversed too often. So I just kept the 33, 70, 75 in there. We are in that zone. We had a quick look below, but look where we held here, a little bit of a trend line forming. And it held 33, 45, 47. That is the a little level to pay attention to, Deresh, perhaps. You look at this here, here, has been traded there, has been traded a number of times, and now it's bit of a trend line support. This is the support on the day, I guess. And then 3400. If you get back above 3400, we're probably going to see it a bit higher. So that's your range. Yeah, in gold it does move. That sort of ranges during the day. So 3345, 3400 is your range for the day. Silver finally corrects a little bit and came back to test this, let's say, the tip of the short-term triangle. Also, that little zone here around 30, 36, 20, 30. It's trying to hold. We're still not far away from it, but as we've been saying so often, the main support is somewhere around that 34.80, 35.15. That's going to be the main support zone. For as long as we are above, nothing really changes. On the day, I'm not sure if we can go much higher. It's going to depend on risk, going to depend on uh, US being closed. We could just hang around here for the rest of the day. Just if it goes back, and I think this should be enough. If it bounces back to 36.85.90 on the day, that should be enough and cover the range for the day. And with that, Ryan, back over to you, mate.
Thank you very much, mate. Great stuff as always. Have a great day, everybody. Thanks for coming to the Flow Show. Take care. Don't go pushing for trades today if the markets aren't compliant. We don't often get quiet periods, so go and enjoy yourself and do something else. Don't rush into trades, force trades. Have a great day.